Welcome to Striking Options. The show reveals the options you have to better navigate markets. I'm Jeff Kilberg, and I'm joined today by Bob Icino. Welcome, Bob.
Good to be here, Jeff.
Well, it's a pretty exciting week. We're seeing the China trade tariff conversations are looking more and more constructive. Every day we get a little bit of tidbit out of Washington. So the question I have for you, is this phase one deal really looking more robust than the market expected? And is that justifying these new all-time highs we're seeing in the E-mini S&P 500?
Well, we don't know if the deal is more robust. We're getting good news out of Beijing as well, so it seems like they're in favor of it. One thing we do know is the market is reacting more positively to positive news than it is negatively to negative trade news.
And that's been the 1-2 punch. We saw the Fed initially be a little more accommodative, but it seems like the paramount focus continues to be China.
Yeah, the probability of rate cuts keeps dropping out into the future all the way to December of 2020, according to the CME FedWatch tool.
Oh, great stuff. Let's get this first lightning round. You ready?
I am ready.
Gold. Well, we've seen the largest weekly drop in about 3 years, Bob. Since November 2016, we haven't seen a drop like this. But I think that's by and large due to the fact we really haven't seen gold go down in a couple of years. So what's your takeaway in the precious metal?
Yeah, well, a lot of the Commitment of Traders report had some good-sized longs in there, so a little bit of long liquidation can cause this kind of a move. So the example I want to look at is selling the October week 3 1450, 1425 put spread in gold. The selling of this put spread allows an investor to collect $310. We do have some support, at least in my view, at around 1450, and this put spread expires Friday, November 15th.
Well, this makes a lot of sense. We've seen this $1,500 level in gold, in the precious metal, really be tethered. And now the fact that we're under 1,500, my question is, will we see a little bit more of these weak longs get flushed out, or will the central bankers continue to bid up the gold price?
I think they'll get flushed out, but I think the majority of them may have been flushed out already. It's definitely a lower at-the-money volatility, but again, versus where it's been over the long historical period, it's pretty high.
Yeah, and this makes a lot of sense. You're going to collect about $310. The underlying future contract is the December contract. It was trading around 1467. And like you brought up, that at-the-money volatility, nearly 13. That's pretty important and significant because that's how we collect option premium. We see that at-the-money volatility a little elevated.
Right, it's been higher recently, but historically, that's a decent level to sell options.
All right, I like that, Bob. And please remember, these are trade examples, not trade recommendations. Let's move into the second lightning round, pal.
I'm ready.
Phase one trade deal. Well, you hit the nail on the head earlier. That's all the market's really focused on in 2019. Seemingly, we have this phase one trade deal, this interim deal Larry Kudlow was talking about a little bit. Interesting to see that the market just continues to accept the fact and embrace the fact that we're getting this deal.
Yeah, absolutely, Jeff. And again, it's all about tariffs, and at least we know that they're not going to advance. They might roll back. We'll see what happens next week.
Well, that's it right there. I think the uncertainty about when we actually see this sign, ink not only being wet, but obviously being dried, and that's what the market's looking for. They're looking for that dry ink, for that deal to be certified. So I think in the short term, we're going to have some volatility. So I want to be a seller of a risk reversal. Can you really quickly talk about what a risk reversal is, Bob?
Sure. It's essentially a short position, but you've got some sort of neutral space in between the two strikes where you don't make money or lose money, especially where you're selling this thing.
And it really offsets or tries to mitigate risk on a long portfolio that does have U.S. equity exposure. So the trade example I want to utilize today, I'm selling a week 3 3125 call in the E-mini S&P 500, but I'm also buying a week 3 2950 put in the E-mini S&P 500. So I'm selling the upside call, buying that lower put. Is actually typically a zero cost, but we're actually going to collect $55 on this credit spread.
Yeah, that takes that sort of neutral area between 3125 and 2950 and allows you to keep that credit if it sits in there, which might happen with the at-the-money volatility trading in only 884.
Yes, and the expiration on this credit spread goes out to Friday, November 15th, but the December futures, the underlying contract in the E-mini S&P 500 was about 3082. That at-the-money volatility, Bob, where was it?
Well, again, 884, and you could also potentially do this by selling the micro E-mini futures, which is a smaller contract, allows you to mitigate risk. That's another way to look at a short position.
In selling that micro E-mini, which is 1/10 the size of the E-mini futures contract, yes, if you have a little bit of consideration, or you're just here at the end of Q4 worried about the actual trade deal being secured, this is an opportunity to really utilize those micro E-mini futures.
Just another good product to hedge with.
All right, Bob. Well, awesome for you coming on here on Striking Options. Make sure you tune in every week as we will continue to strike options.